Hello, welcome to another real estate podcast episode. Welcome. Today's topic is real estate investing in a pandemic world. And my name is Siwing Yi from the Yi Real Estate Network. We've been helping out-of-state remote real estate investors to buy turnkey cash flow properties in the best markets in the country over the past almost 20 years. And we are targeting mainly the South and Southeastern portion of the US. And our special guest is Mr. Richard Advani from Supreme Lending. He is our go-to investment loan agent for our network of investors over many, many years. And Mr. Advani and his investment company has helped thousands of investors to get financing so they can leverage their real estate portfolio to achieve their financial freedom. He does investment loan in all 50 states. He also does owner-occupied loans everywhere as well. So without further ado, let's begin the podcast. So thank you for watching. And I want to start off by saying that let's fast forward 10, 20 years from now, and when you have children or grandchildren, and they can ask you, Dad or grandfather, what one financial decision that you make in your past that changed the trajectory of your financial future? And your answer could be, well, thank you for asking, son or grandson or granddaughter. One event that we did that changed the trajectory of our financial future and made it a lot better for our future generation. Back in 2020 to 2022, during the pandemic, we had the courage to pull the trigger. And as a result of our action plan back in those days, our financial future is set. So that could be a situation that. So two more things I want to mention. The herd mentality, HERD, the herd mentality. So when most people go one way, you go the opposite way. You do it completely opposite when the mass of the people going. That is a mark of a potentially a true successful investor. You know, you do what everybody doing going on one way, and you just do it in an opposite way. The few of us. And one more thing I want to mention before Richard can share us your thoughts. Warren Buffett. Warren Buffett, as you know, is the Oracle of Omaha. He's one of the most successful investors in history, Warren Buffett. He said, one of his quotes, and he has many, one of his quotes are, be fearful when others are greedy, and greedy only when others are fearful. Now, during the pandemic, I challenge all of you to be greedy when many others are fearful. All right? It's not easy. So today we could talk about, what's going on, with the amazing record low inventory of supply of homes, and then the continued demand. And we talk about the record low interest rates, but the risk will go higher up based on what the Fed had just mentioned recently. But before we go through the details, Richard, can you add anything further to my two philosophy of real estate investing I just went over? Any additional thoughts before we go into the details of the today's market condition?
No, but I mean, I definitely concur. I think a lot of us as real estate investors have learned, obviously, that the key towards long-term wealth and success is investing through real estate. And, at the end of the day, when there is a situation that most people are running from, like, post 2007, 2008, I know a lot of us did take advantage of it and buy some properties, but man, if we could have bought more properties, I think that's what every single person says is if I could have gone back, I would have bought more. I can tell you this, in 2008, when that last meltdown happened, I was in my low 20s. And if I know what I knew today and had the resources, of course, that I have today, being a little older, man, I would have done some damage. It's, however, that is also easy to say, right? In hindsight, generally as human beings, the way we work is, if you see the real estate market crashing, you sell everything you have, right? You see a stock going down, you sell everything you have, when in all reality, what you should be doing is doubling down and dollar cost averaging and, buying more real estate. Sure, we all want to catch the bottom and sell at the top, but more often than not, that leads to us just sitting on the sidelines. Yeah, and as you noted, especially we had another example of it here through the pandemic, the first 6 months. Everyone was worried about what is going to happen to the real estate market, to the rental market. And a lot of people did capitalize during that time. And, obviously, as things have calmed down, now we're in a position which, the position is the point of this call, which is that there's no inventory. It's very difficult to find rental properties right now. However, it's still an amazing opportunity, right? And I think that's kind of what we're going to cover today, where, we haven't completely missed the boat, but, in the perfect world, the first couple months of the pandemic, when everyone else was shying away from stuff, that's when all of us, should have tripled down on things.
Yeah, Richard, I want to mention some specifics. At the beginning of the pandemic, as I recall, almost 2 years ago now, March 2020, when the interest rate went all the way down, and then we were, working. I want to highlight one market that some of our investors enter into as a result of our recommendation through our network and that market, as you know, is Austin, Texas, right? I mean, I don't know how many, maybe 15 or 20 of our investors, they purchased single-family home rentals in Austin area at the beginning of the pandemic when the prices were around $220,000, $230,000, brand new construction in and around 20 minutes from Austin. And surprisingly, during that 12 months period between 2020 and 2021, their property have increased 40 to 50% in just like that appreciation. It's just 1 6 months time frame. That's just one market. I don't want to spend too much time on it. There are several other markets in Florida and North Carolina that we also took our investors to in the past 24 months, and they made out like a killing 20, 40, 50% appreciation, which is shockingly record breaking. So now some people are thinking as we begin the 2022, as you alluded to, which we can talk about right now, people are thinking, oh, there's no way the real estate prices will continue to go up. Well, yeah, that's sort of true. But however, you have to look at the current situation. Right now, as we speak, in February, already February 2022, right now, Richard, you are not hearing that right now, the record low inventory is even worse than a year ago. And a year ago, that's when all the appreciation has occurred in many markets, double digit, triple digit, or whatever. But today, right now, record low inventory, not even 1 month of supply of inventory, not even where 6 months is a normal market. This is crazy. No homes to sell. Let me give you one more example. Okay, Richard, you and I, we live in one of the most expensive real estate locations in the country. I live in the San Francisco Bay Area, and you live in Southern California. So let me give you one example. What's going on in houses here in the Bay Area? So I mean, we're talking. Some of you know what I'm talking about. Many of the homes in the Bay Area, San Jose, in the East Bay, and a 30-mile radius of San Francisco and San Jose, the housing right now is like $1,000 per square foot. We should think about this: $1,000 per square foot. That means in the Bay Area right now, if you want to buy a home, 1,000 square foot is a condo or a townhouse. That is $1 million. 1,000 square foot townhouse, 2 bedroom, 1 bath, built in 1980. If you want to buy or 1960s, Southern California, which is the same, right? You have Orange County. When a typical single family home in Orange County is like 1.5 million, or in LA, depending on what neighborhood, is a million or more. And then the Inland Empire is skyrocketing prices, right, in your area. I mean, we're talking 20-30% appreciation in the past 12 months as people are moving into the suburbs in Southern California. Same here in the Bay Area. I mean, in Oakland, for example, where my son was trying to buy, he got outbid for the past 6 months. He's trying to buy a house in Oakland, like 2 bedroom, 1 bath, like 1,100 square foot. The list price is around $899K. And those neighborhoods are not that great, like a B minus, a C plus neighborhood in Oakland, right? If you know about Oakland over the years, I mean, it's a rough neighborhood, and still is in many parts of Oakland. But we're talking a house built in 1950, 100-year-old, 1920, 100-year-old, 2 bedroom, 1 bath, 1,100 square foot. The list price is $899K. Let me give you a real example. And then after 15 multiple offers, the winning bid was like $1.2 million, all cash purchase offer on a rinky-dink house, like maybe even as a fixer-upper. I mean, this is shocking how home prices increase. Let me give you another example. I just talked to one of my realtors in San Jose, a very good friend of mine. He said he's listing a house, a single-family house in Cupertino. I know Cupertino is a very, very good school district. Cupertino right next to San Jose. That house is like 1,000 square foot, single-family home, 2 bedroom, 1 bath, and built 1950. It was listed at $1.5 million. $1.5 million on that 1,000 square foot little house in Cupertino. This is insane how prices have risen. Now, Richard, you and I, we're promoting houses in out of state, Florida and Texas, whatever, where we're helping our investors buy $250,000 single family home new construction, the cash flow, or $300,000 or $350,000. That's the maximum range. But right now, record low inventory. I mean, almost no houses for sale right now, and the demand is continuing to be strong. And then the interest rate is around in mid threes for owner-occupied buyers, and for investment loans around 4%. So, Richard, take it away. What are your thoughts about the market going on for the rest of this year, 2020?
Yeah, well, I think my response is kind of two-pronged. One is I'll talk on interest rates. Interest rates have risen very, very, very sharply this year. The 10-year treasury bond is at 1.8 right now. If you guys didn't know, mortgage rates aren't based on the Fed rate or the prime rate. They move with the 10-year treasury bond, and typically they move daily. And that treasury bond has rallied up 40+% this year. So with that, mortgage rates are probably up about 0.5% in the last 60 days or even less. And the general consensus is that treasury bond is going to close close to the 2.0 mark through the end of the year. Now, hopefully what that means is much of the increase that's going to happen in rates this year has already happened. I think if you're buying a rental, whatever we quote you today, be prepared if it's closing, 3 to 6 months from now or through the end of the year, be prepared for rates potentially being about 0.25% higher than today. However, I know it sounds dire, but it's really not, because you got to keep in mind, prior to the pandemic, we were at all-time lows on interest rates. And even with this rally upwards, we're still right below the prior all-time lows. Okay, so rates are still extremely attractive, even if you're getting a rental in the low to mid fours. Besides the last year, historically, it's the lowest they've ever been. And inflation is out of control, as we know. It's still such an amazing hedge against inflation, that 30-year fixed, at those rates. A lot of people ask me, as you can imagine, I'm sure you get asked too, Sealing, on the daily, is it a good time to buy? And to me, it's always a good time to buy, right? Because if you try to time the market, you're going to sit on the sidelines and you're going to earn nothing. Like, how many people do we know in the last 2 or 3 years that determined they wanted to sit on the sidelines and then obviously didn't take part in any of the growth that we've had in the last year or two, which has been explosive. I think things are going to continue to go up and probably level off. Obviously it's not, obviously it can't sustain the rapid increase that it's having forever. But that doesn't mean it's not a good time to buy. Obviously, if you're buying in areas with good fundamentals and good growth, rent inflation is still yet to come, meaning, the increased rents from the increased property values typically lags, about a year, since most leases are about a year. So, anything that we buy today, in my opinion, we can project, or anything we bought in the last couple of months, 10 months from now, when you go to rent it out again, rents generally are going to be a little higher as well. So yeah, I mean, it's still a good time to invest. Maybe if you're trying to buy 3 or 4 properties, maybe don't buy them all at once, buy one, wait 3 months, buy another, wait 3 months, buy another. So you catch the market where it's moving. And, Wing and I can talk to you more individually about strategy on how to deploy, obviously, your funds.
Yeah.
But it's a good time to diversify too. The stock market is through the roof, right? There's no more upside. Whereas real estate, you still have upside, which is cash flow. It's appreciation. It's the fact that no matter what your front end cash flow is, you're still paying on your balance every month too. So, there's a back end return. So there's a couple different plays towards real estate that make it attractive, versus securities. And I think another reason why inventory is so low is so many people have, kind of realized the same thing. And they're like, look, I've got $600,000, $1 million, $2 million in RSUs or in stock. And I own no real estate and I need to diversify, so I think the demand for rental real estate is going to stay pretty strong for a while. And the supply is extremely low. People are signing contracts into 2023 and beyond just to have a part in the market. And, even if things slow down, that demand that's there is still going to stay strong. And, okay, maybe it won't take you a year and a half to buy a property. Maybe you'll be able to buy one in 6 months. That's good. But I don't think that the supply is going to increase so much and the demand is going to decrease so much that all of a sudden the market's going to reverse from where it is.
Yeah, I agree, Richard. Now let's talk. I want to make 2 distinctions between real estate investors and versus owner-occupied buyers with respect to interest rate. Now, here's the thing. I mean, the owner-occupied buyers, especially for some people who are on a tight budget, if the interest rate increased like 1% or 1%, then their purchasing powers is reduced by equivalent 10%. So therefore, that's where the affordability factor comes into play. That may impact somebody, owner-occupied buyer, want to buy a $600,000 house or $1 million house, and if the interest rate have increased from 3.5 to 4% for owner-occupied buyer, then there's a chance that that buyer will no longer qualify for that house. But for investors, it's different. Even with a 4.2% investment interest rate at today or whatever, for the foreseeable future, investors are not affected by the interest rate increase that much because we are, as an investor, we are buying properties that are much lower cost. We're buying properties that cash flow like 250 to 300K to 250K. I mean, that 4.2% interest rate, giving the cash flow factor that the property we are selling, for example, now $300,000 single family home that we are promoting, if it rents for $2,200, I mean the difference between 3.7% versus 4.2% is only a minor difference in the monthly mortgage, like $20, $30. That's not going to affect a real estate investor that much. So real estate investors is all about cash flow. It's all about rent to value ratio. As long as the rent you're collecting are able to pay it off your monthly mortgage, taxes, insurance, property management fee, and a vacancy factor, at the end of the day, you still have a break even or $200 or $300 monthly positive cash flow. That's, all you care about moving forward. So that's a distinction. So yeah, investors have a different mindset. It's not that much about interest rate. You still can cash flow in a market that we're promoting in the South and Southeast. So what are your thoughts, Richard, about the interest rate risk analysis?
About the interest rate risk analysis?
Investors, what I just said about risk investors versus owner-occupied buyers. We look at.
Yeah, I mean, as you say, rates aren't going to have as much of an impact to, I think, investor buyers, although our cash flow bottom line is important to us. It's not going to make, in my opinion, versus other investments out there, it's not going to make us not buy a property as rates go up. However, with primary home buyers, obviously, a 1% increase on a, $4, $5, $6, $800,000 $1 million loan can make a significant impact to what they would qualify for, which could affect a huge amount and a huge number of those primary home buyers, where I think investors are a little more resilient because, of course, we do have cash flow covering that mortgage payment. And although obviously if rates go up, our cash flow will go down, it's still going to be a positive overall investment, and a good overall investment compared to what's left in the various markets for investment and in securities and so forth. So I think an increase in rates is going to have an overall, hopefully a more positive impact for us as investors, because we're going to be competing less with primary home buyers. So, I definitely agree there.
Yeah. But furthermore, Richard, right now, as real estate investors, there's so many people renting. There's, you and I've been hearing in the past few years, even before the pandemic, our investors have no problem renting their homes out for obvious reasons, because in a market that we're promoting in the South and Southeast, there are many more renters than there are available homes to rent. So there's a good sign. Now, even if the interest rate goes beyond 4% for owner-occupied buyers, then that creates an affordability factor. Then many would-be home buyers, they will not be able to buy their first home. They're going to be relegated to renting. So that's a good sign for investors, because we can have more, renters going to be fighting over our limited available of investment homes to rent. So that makes the vacancy factor almost non-existent. So that bodes well for listing investors. So for the remaining few minutes we have for this podcast, Richard, in my projection for not only the year 2022 and beyond, given what's going on in the economic environment, low record inventory still will be able to housing will going to increase in value. I mean, that's the fundamentals. That's how it is. And then like I said, I mean, a lot of different organizations, they project 7 to 10% appreciation. Zillow have projection for good appreciation, not as much as last year or the year before. Redfin, similar, and a few other organizations, they project continue rising prices for the reason we just stated. So investors, I feel 2022 and 2023, maybe even the next few years, we can expect some modest increase in appreciation on our investment properties. And then, but the rent will continue to rise, acceleration of rent that gives investors more cash flow than we have right now even. So that bodes well as well. So at the end of the day, is buy and hold long term for our real estate investors, because you can, by staying the course, by showing discipline and buying for the next 5, 10, 15, 20 years, buy and hold, and do not panic, do not be overly emotional, because if you look at history, investment history, if you buy and hold long term, things will always work out for you, because inflation and history will go, your real estate asset, your hard assets is always one of the best attractive investment class. So the remaining 1 minute we have, Richard, what is your recap and your final thoughts before we conclude?
Pretty much the same as everyone, which is at the recap of every call, it's just get off the sidelines, right? If you're been waiting to invest in real estate and been waiting for the perfect time is now, right? Taking action is the perfect time. And look, we all want to buy high, buy low, sell high, right? We all hear that. It's played out. That's great. I mean, but if you even listen to Ray Dalio, right, who's one of the wealthiest, most respected investors out there, even he'll tell you, don't try to time the market, because more often than not, leads to you sitting on the sidelines and also being a victim of that mentality, right? If you're 3 years ago, 2 years ago, I have a plethora of clients who were like, no, it's gone up. I'm going to wait. You'll see. And I'm going to wait for the crash and then buy. And, you know, that way of thinking has cost them 30-40% appreciation in the last couple of years. But even worse, they're still victim to that way of thinking. So now they think even more so, I'm going to wait for the crash. Like, yeah, I should have bought it 2 years ago. You're right. I missed out, but I'm going to do the same thing again. They make the same mistake, which is, well, now it is. So, you know, you got to break that type of thinking. Like I said, dollar cost average, you know, and people are like, well, what are you going to do if property values drop and the market crashes? I'm like, buy more. A great time to buy it, you know? But that doesn't mean stop buying in the meantime, because, you know, the market's been going up since what, the crash happened 2008. So I think maybe mid 2009 things bottomed out. So we're going on 12 or 13 years now, guys. You know how many people 6 months in, or excuse me, 6 years in, after 6 years after, so 2015, 2016, 2018, that we're like, oh, I'm cashing out. Everything's been going up for 6, 7, 8 years now. I'm done, you know, and you know, the market's going to crash. We've been hearing that for 6 years, and you've lost out on 80% appreciation in the last 6 years. And where people thought it had already gone up and it wasn't going to keep going, you know, they decided to sit on the sidelines. You know, you're leaving real wealth on the table. And, you know, if you do have a chunk of cash to deploy it strategically. You know, we can all talk about how to do that, but sitting on the sidelines is silly. You know, take some of those capital gains from some of your stocks, and, you know, sell some of them, invest in some real estate, and, you know, bonus depreciate them to wipe out those capital gains that you would have paid otherwise on the stocks. Like, there's a huge strategy behind you know, kind of trying to diversify your portfolio and get started on the real estate journey.
That's right, Richard. You and I work as a team. You know, I help our investors to buy cash flow turnkey properties in the best growing markets in the South and Southeast. And Richard, your financing strategies are so crucial to leverage people's wealth. So you and I are such an important part of a team of real estate advisors to help investors to achieve their financial dreams and goals. Well, with that said, thank you so much, Richard, for your great perspective and knowledge and wisdom again. Thank you for attending. And Richard Advani from Supreme Lending, thank you so much. And this is Siwen Yi from the Yi Real Estate Network. Thank you for attending. And we will see you on the other side. Thank you so much. Have a nice day. Bye-bye.